All right, let's just get right into it. Today, we're opening the files on an explainer covering what is easily one of the most wild financial true crime stories of 2026. We're looking at a market event that totally defied logic, shattered trust, and honestly left a trail of financial destruction so massive that it caught the attention of major global exchanges and top-tier on-chain investigators. We're doing a full autopsy of RaveDAO.
I mean, it's the ultimate question, right? It really hooks you. How exactly does a $10 billion crypto empire just vanish in 24 hours? How does a token go from total obscurity to a multi-billion-dollar valuation only to literally evaporate overnight? Well, to figure that out, we have to peel back the layers of what analysts are now calling a textbook market illusion.
So, to understand the fall, you first got to understand the bait. Back in early April 2026, RaveDAO's token, ticker symbol Rave, went on an absolute tear. We're talking a staggering 3,765% gain in just 7 days. It shot up from around 25 cents to almost $28. It was this crazy parabolic run that created a massive FOMO trap, pulling in all these retail traders who are just terrified of missing out on the next big crypto millionaire maker.
But instantly, you have to contrast that meteoric rise with the brutal reality of what came next, a 95% drop. The token collapsed just as violently as it surged up. It obliterated billions of dollars of wealth overnight and left all those late buyers holding practically worthless bags.
Section 1. The billion-dollar wipeout. Guys, this wasn't just a minor market correction. Over $6.46 billion were wiped out in a single 24-hour window. To really put that into perspective, that is larger than the market cap of a lot of publicly traded companies. Just gone. Poof. Retail traders, the everyday people who bought into the massive hype, were left completely stranded when the floor just completely fell out from underneath them.
Which brings us to Section 2. What is RaveDAO?
On the surface, the project was incredibly compelling. They pitched themselves as this Web3 native entertainment collective, basically merging electronic music culture with blockchain technology. And they promised these awesome community-owned live experiences. And look, it wasn't just digital vaporware. They built what looked like a super legitimate ecosystem with massive real-world events. We're talking sold-out shows in Dubai, Singapore, and Lisbon, drawing literally hundreds of thousands of attendees.
And it wasn't all just about the parties either. They spun up this really powerful charitable narrative. They funded over 400 cataract surgeries in Nepal and supported over 150 meditation programs across the US. Because hey, nothing calms investor anxiety quite like a Web3 meditation sponsor, right? But seriously, when you combine that philanthropy with reported partnerships with massive entities like Warner Music, it creates a deeply convincing illusion of safety for the investors.
Moving on to Section 3, the 6,000% squeeze. Let's walk through this, because it's a textbook manipulation pattern. Binance Square analyst Xingjiabu Shan broke it down perfectly into 3 distinct phases. Step 1 is the slow bull grind. For months, the token price just slowly churned along at low levels. Then, Step 2, a violent surge. Suddenly, a giant bullish candle just shoots straight up, driven by completely abnormal volume and extreme leverage. And finally, Step 3, needle threading. This is where the price hits this totally unsustainable peak with absolutely zero fundamental support beneath it, perfectly setting the stage for a devastating crash.
So the crazy part is exactly how that surge was engineered. As Rave hit its all-time high of $27.94, $43 million in futures liquidations were closed out in a single day. At the time, get this, 74% of futures traders were actually bearish on the token. They were heavily shorting it. But as the price was artificially pushed up, those short sellers were forced to buy back their positions just to cover their losses. And that created a massive, uncontrollable feedback loop that sent the price absolutely skyrocketing. It was your classic textbook short squeeze. Section 4. Exposing the 98%.
Naturally, the whistleblowers began sounding the alarm. Prominent on-chain investigators like ZachXBT and analysts like @MasterXYZ started spotting severe red flags deep in the token's infrastructure. They began pointing out that this incredible price action wasn't being driven by organic, real-world demand at all. Instead, it was driven by extreme centralization that essentially resembled a coordinated pump and dump scheme.
And here is the ultimate smoking gun that totally shatters the illusion: the token supply distribution. Over 95% of the entire supply was held by a single, presumed team address. Add in the exchange-linked addresses, and retail investors held barely over 1%. 3 wallets held nearly the entire supply. The team completely and absolutely controlled the market.
Now, this extreme supply concentration created a super dangerous mirage. At its peak, Rave boasted a fully diluted valuation, an FDV, of $10.3 billion. It looked like an absolute titan of the industry. But analysts pointed out that the effective market cap, which is based on the actual circulating tokens, was only around $200 million. By hoarding 98% of the supply, the operators created a totally fake inflated valuation. It tricked retail investors into believing there was this massive pool of liquidity, when in reality, the float was incredibly thin and so easily manipulated.
Section 5. Why retail always loses.
Consider this incredibly sobering statistic, compiled from regulatory bodies like the UK's FCA and ESMA. Between 70 and 89% of retail traders lose their money on leveraged crypto platforms. I mean, that is a staggering failure rate, and it clearly tells us that the playing field is just not level.
And here is exactly why that happens. The system itself is mathematically designed with structural advantages for the house. The exchanges profit from liquidation fees when your trades fail. They benefit from spread manipulation and their own internal market-making desks. They capitalize on funding rate imbalances. Basically, the more volatility there is and the more retail capital gets destroyed, the more money the platforms make.
You really have to understand that when you trade in these environments, you aren't just fighting the market's natural ebb and flow. You are literally fighting algorithms. Internal liquidity engines can effectively see exactly where retail stop losses are clustered together. So those sudden violent price wicks, they are often algorithmically targeted to hit those exact levels. They wipe out traders, liquidate their positions, all while feeding them flashy dashboards and dopamine hits to trigger these addicting reward loops that just keep people coming back for more.
Which brings us to the end of our autopsy, and it leaves us with a pretty critical question to chew on. We've seen how billions can be generated out of thin air through artificial scarcity and then destroyed in an absolute flash. We've looked under the hood at the mechanics of manipulation and the massive structural disadvantages that everyday investors face. So I leave you with this thought. In a game engineered by algorithms and insiders, designed mathematically for you to lose, is the only winning move not to play?